Hi, everybody. Welcome to our webinar today on PPP loans. Today, the speakers will be covering eligibility for the PPP loans and loan forgiveness and the programs involved. And then this is part one of our program, and part two of our program will be next week, focusing on the consequences of getting the loans, enforcement issues, tax implications, and impacts on businesses. So I want to quickly introduce our speakers and our moderator, and then we will move on to the program. First, want to introduce Lawrence Johnson. Larry has deep executive experience leading established and startup enterprises. He is the founder and CEO of L.R. Johnson Associates, LLC, a specialty foods distribution and marketing firm. In addition, Larry serves as director of the Center for Strategic Corporate Development at El Camino College's Business Training Center. He also serves on the board of Wells Bring Hope, a not-for-profit that drills water wells in Western Africa. William Norman, who is a frequent and wonderful speaker at our Beverly Hills Bar Association programs, is a partner at the Southern California tax law firm of Norman and Zach. He's a certified specialist in taxation law. He is admitted to practice in California and Wyoming. He has been practicing tax law for over 40 years, and his practice focuses on international tax issues. And then we also have our moderator today is Levon Lawson, provides tax law counsel and representation to businesses and individuals in tax controversy and litigation matters. In this capacity, she handles federal and California state income, employment, and transfer tax issues. Her practice also includes matters involving international asset and account reporting. She additionally provides outside counsel services to small and growing enterprises, and she is also of counsel at the law firm of Albrecht and Barney, which practices in the areas of estate and gift tax law and estate planning. Ms. Lawson is also a former senior attorney with the IRS Office of Chief Counsel. And so, Levon, I am going to hand it off to you.
Thank you, Michelle. So greetings, everyone. Welcome to this overview of the updated Paycheck Protection Program. It is my pleasure to have the opportunity to moderate. A couple quick notes. One is that questions are welcome. We will attempt to answer questions throughout the program, but where it's applicable and fits. Otherwise, please note that we will particularly make space at the end of the program to do questions and answers, so not to worry. As Michelle indicated, this is part of a two-part program. The program next week on the 28th addresses what happens after the tax, audit and enforcement, and corporate business issues. Hope you'll join us next week on the 28th. But this program will be addressing these important issues with respect to eligibility for the Paycheck Protection Program, the application process, loan forgiveness, and also some very important other programs.
Levon, I forgot to mention one thing. I really apologize. I need to thank our tax section sponsors, Hoffman, Salkman, Tasher, and Perez. We want to thank them for their perennial sponsorship of the tax section. They are a very highly esteemed, highly respected tax firm here in Beverly Hills, and we want to thank them for our sponsorship. I apologize for the interruption.
Actually, no worries. I wish that I had gone ahead and thanked them when I saw the sponsorship up there, because we are very grateful to our sponsors. So thank you. And Michelle, thank you for coming back in for that. So real briefly, just to tee this up, this program will address eligibility, the application process, loan forgiveness. We'll also touch upon a couple of other very important programs that are not part of the Paycheck Protection Program, but in a way it can be connected. For instance, the EIDL targeted program is very important. And there are some updates and clarification regarding the relationships between the EIDL and the Paycheck Protection Program, and also the shuttered venue grant program is very important. So again, just to tee this up real quickly, on December 21, 2020, Congress passed the Consolidated Appropriations Act 2021, which provided government funding and provided some additional important stimulus to those who had been severely impacted during the pandemic. This bill was signed into law on December 27, 2020. The stimulus continues many of the relief programs provided under the CARES Act, but it also provides new funding for the Paycheck Protection Programs, makes certain changes to the program, provides clarifications to important questions, and includes a second round of funding for a second round of targeted loans. The Small Business Association published implementing regulations on January 6th. This program resumed on January 11th, and the SBA started taking applications for the second round loan applications on January 13th. Second round provides some recognition that many communities were left out of the prior round of funding. Accordingly, the second round, or what we are calling finally the PPP2, is more targeted, focused on helping those particularly harmed by the circumstances surrounding the virus and the shutdowns. Bill Norman has provided a quite comprehensive guide, which is a wonderful reference. We will not be going through all of it, but our speakers will be touching upon the highlights and very important parts, such as basics of loan forgiveness, eligibility, for the application, as I've indicated, and so forth. So with all of that, I'd like to turn this over to Larry. Larry, could you get started? Tell us what's going on.
Sure. Well, this new iteration of PPP is very exciting in that it provides significant improvement. As you mentioned, it provides opportunities for those folks who were not adequately treated the first time. It reserved special time for small businesses, minority-owned businesses, businesses in low-income communities to have access to get PPP funding a few days before everyone else was allowed. And it also established extra targeted funds for small banks, small capitalized banks that service the underserved communities, that they have a special pocket of funds that they can tap to serve smaller businesses. So that's another advantage of the program. It also broadened the types of expenses that would be viewed as forgivable expenses for those businesses. And it also broadened what could be defined as income. So it provides extra advantage. And most importantly, it gives advantage to hospitality and restaurants by allowing them to get a larger bite of the apple. They can multiply their income by 3.5 in order to arrive at their lendable funds. So those are the highlights of the program. I'll pass it on to Bill.
Thank you. That was excellent summary. Let me just begin on slide 9, if I can. Since most of us probably who are attending are lawyers, I put together in here, on slide 9, some of the authorities that we use to actually determine whether our clients will qualify and what the amount of forgiveness would be. Forgiveness being that they don't have to pay the loan back if they meet certain requirements. There's basically just 3 statutes. I've got a list of more of them here and some other items, but the original provisions were in the CARES Act, which has the site there. Not all of the CARES Act deals with this specifically, the PPP loans. Then we had something called the Paycheck Protection Program Flexibility Act, which just changed some rules that were in the original CARES Act, made them more borrower friendly, if you will. And then, as Levon mentioned, what prompted this new set of rounds, if you will, funding and new rules was we're calling the Economic Aid Act. It's part of this Consolidated Appropriation Act, which is like 5,500 pages long. But if you go around page 2,000 or so, you can find the PPP provisions, as well as these other programs that Levon and Larry mentioned, the shuttered venue, for instance. On the next slide, I put together, again, a little list of what I call the regulatory guidance. This has been made much more friendly than in the past. I don't know how Larry's view is of the list that we had of all these what they call IFRs, interim final rules, which is kind of a contradiction. But in any event, we had a number of them. We also had a number of called frequently asked questions, which kind of came in. Each week we got a new set of questions, but we didn't really know they were there unless we actually went on the side and looked at the end of the document that was accessed. But what we have now is we have a consolidated list of so-called IFRs. It's kind of like the regs all put together, which was issued in 2021. We have a loan forgiveness as well, and one that somehow got missed out of this list. We have another IFR, which are on the so-called second draw. So now there's a lot less you have to look at. You really can just begin with these consolidated rules and the other IFRs that were issued in 2021 in January. You basically got everything there. If you want to go back to the statute, obviously you can. And then, and I won't go through it because we'll talk about it later. There's some new applications. We have a new application for we call that kind of the first draw, so to speak. And then we have an application for so-called second draw, which is if you've already got a draw, already had a loan, and now you're going to a second one, which is and you qualify, then there's an application for that. And then we have some loan forgiveness applications, which one for small companies, one so-called easy one, and then the kind of standard one. So we've got three there. You obviously pick the one that for your client that's it's the least complex and the most favorable as well. So that's where everything is. And I think it's a lot easier to work with this. Personally, I mean, the way I do it is I like when you kind of do a tax return, I kind of look at the form and see what I can put in there. And then I go to the instructions. And then if I still don't understand what's going on, then I look at this consolidated guidance. I mean, that's the way I would approach it if with respect to a client who was a borrower. Okay, so that's kind of that introduction. I just wanted to go through. Let's go to slide 19, and we can just talk in general what's happened here. What we have now is basically three types of programs. We have the first draw loans, which includes we're talking about people who didn't get the first round, so to speak, as Levon calls it. Before the act became this Economic Aid Act became effective, which was December 27th, 2020. I think it came out of Congress on the 22nd, but our president took a few days to decide whether he was going to sign it or not, and finally did. So it's effective the 27th. So we end up with people who have not taken the first round, so to speak, haven't done anything for various reasons. And I've had some clients where I've told them about the program and they just didn't want to do it, for various reasons. But some were concerned that they maybe didn't have a necessity and that they really wouldn't get the benefit of a complete grant. But anyway, we have a first draw, which we're going to talk about. And then we have a situation where you can increase what you received in the first round for various reasons. The most important one from that I've seen and people I'm advising are ones where partnerships or LLCs can increase the amount of their loan if they did not in their original application include the owner compensation as the partners, an active partner share, a general partner, or an active LLC member. So that's I think an important increase. Now you don't just increase it by $700,000. It's limited to $100,000, which ends up being, depending on your covered period, an additional loan amount of about 2.5 times the average monthly amount for the self-employed persons or partners, subject to that $100,000 annual limit, which we can talk about. So let's just briefly look at the first draw situation, which we have on the screen here. Basically, we have the definition of a small business concern, which I'm not going to go through, but there may be some things in here that are different than they were on the earlier statute. We've got housing cooperatives and some destination marketing organization, which I know are different. I don't have any in that category. Maybe move to the next slide here. News organizations is another one. The basic requirement is, with some limitations here, you had to be in operation on February 15th, 2020. This is here. Then we go to the next one here. And maybe skip to, let's see, 22, I think. This is a requirement here as to whether the 500 employee or the 300 employee applies and how you determine it. I didn't have any ones that were runs in 200 to 300, but I didn't have any that went over the 300. So I didn't have any dealing with this particular set of rules. I don't know, Larry, if this anything that's that you've been working with? He's got his own boot for a minute.
Okay, yeah. No, just that the general requirement is qualifying size is 300 employees, and that under the first draw in 2020, that threshold was 500 employees, but under the new program, the PPP2, it's 300 employees.
You know what?
I guess go ahead. Yeah.
I'm going to ask that because I know that we have a lot of important information here, but I know that our time is somewhat limited. I was wondering, because I've also seen a question in the Q&A as well, can we kind of go straight to just providing clarification, the distinctions between the first and the second draw?
Let me get some. We'll get to that. We'll get to that. We have enough time, I think. I wanted to go to the slide 28, because this is a list of the ineligible people, and the first one is already engaged in activities illegal under federal, state, or local law. And so there's some questions about the cannabis industry. I don't know if that's something people are interested in, because I would presume it's illegal under federal law, if not state law. So those people may be out.
Federal law trumps.
So Bill,
that may change, but at least I have to change pretty quickly, I guess, because the program won't last long enough, or the funds won't.
Hey, Bill, this question, people are wondering what the first draw is. Can we make a distinction that basically these are rules about eligibility for the PPP loan either way, but there was a first set of loans that we're calling the first draw. And then there's a second set of loans if you've already taken the first set. Is that the distinction?
No, well, you can have people who took loans in the let's say before December 27, 2020. So you call that the first round. Okay. And then if you didn't take it in the first round for whatever reason, you haven't taken any PPP loans, and then after this, it's December 27, which is where we are. A few weeks into that, then you can take your first draw if you've never taken a loan in the past. Okay. If you've taken a loan in the past, then you can either increase the loan, which we're coming to shortly, or if you don't qualify for the increase, you can take the second draw, which has its own special requirements. One being a reduction in revenue, which is quite important. So we will get to that.
Okay.
Yeah.
So
So,
Bill, I might add one thing that might help with some of the clarification, right?
sure, go ahead.
So the PPP was closed. It ran out of money, right? Congress refilled the coffers and opened it up and even expanded some of the features and requirements, but they kept the basic fundamental guidelines for how you get it in place, except that they said if you hadn't gotten it before, you can apply for it again. And as Bill just said, if you got it before, but you eliminated something that would advantage you, not if you made a mathematical error. There's a big distinction here. You had to have omitted something that would have been to your benefit, and you can go back and adjust that and apply for the balance that you did not get. Now, not everybody will want to do that, because it may make more sense for you to go for PPP second draw. You may get more of a return for that. Hope that
Yep,
helps.
exactly. Yeah, the on slide 49, for instance, there's a discussion of how much you can, the maximum amount of loan that can be taken. We're still talking about this first draw for people who didn't take it the first time. And so we've got a number of slides to deal with that. That has not been a major change, as Larry mentioned. If we go to 69 and 70, for instance, with slides, I want to talk about, how can you use these? And this has changed somewhat, not in principle. I'm talking again about this first draw. On the slide that's on the screen here, it's not, I guess not 60, slide 60. If you can get to there. But in any event, the cost that related to it's a life, disability, vision, and dental insurance was added. This is not going to be well, it could be a big number. But remember, it's just going to be this average monthly times 2.5 times, so it will not be that big for a lot of people, a lot of borrowers. And then if we go to the next slide, which is 61, these are some new categories that are where you can, the uses that you can make of your PPP loan fund. You still have the 60% for payroll, as slightly augmented by what I showed on the prior slide. But the rest of the other 40%, which has to be for eligible costs, they've added some new categories. It's item Roman numeral 8 here, so-called covered operations expenditures. Basically, software and cloud computing costs that were incurred for the reasons that are described here. A lot of it because their companies are having to have a lot of workers work remotely, and so this is some of those costs get included. Damage costs for vandalism and looting due to public disturbances during 2020. So it excludes the insurrection, but I don't know if that was mostly the government buildings anyway. But anything that happened during 2020 that wasn't covered by insurance, had to pay for that. That ends up being also a new cost. And then on the next slide, on slide 62, there's another category, which is so-called supplier costs. So certain expenditures, depending on when they were made and for what purpose, will also qualify.
So Bill, this is extremely important, Bill. What you've just gone over is that they've expanded the definition of income to include a variety of insurances that were not covered. And they've also expanded the types of expenses that can be deductible. This is a tremendous advantage to businesses that can really mean dollars in people's pockets, and they should pay attention to those two areas that you've just mentioned.
Exactly. Yeah. It actually depends on how much payroll you have versus your other, how much you borrowed versus your payroll versus other costs. So it can be, yes, it can be important. And to the extent it's that part of it's forgiven, as Larry alluded to, but we'll talk about in the, not me personally, but in the next piece of this webinar, we'll talk about, whether it's deductible or not, which everybody knows, I think it is, but it's a little more complex than that. The next category there on 63 is, I guess, PPE, I guess what we're calling it. Personal protection equipment basically is here, and a very complicated definition, but that's also can be a major cost for a lot of lenders. Slide 65 just mentions that 60% rule is what you have to use. You have to use 60% of the proceeds for payroll costs. So if you've got a misuse of funds, which is what we'll talk about next time, I'm going to skip over that, but those are not pleasant results, or if you will. So we'll take care
I
of
guess
that.
if there's a misuse, would those be applied, discussed at the next program next week in terms of misuse?
I want to mention the certifications on slide 72.
Yes.
Briefly. These are kind of lead-ins to part 2. On slide 72, this is just the complete text of the certifications that are in the guidance. By the way, most of the set here, I've just edited lightly the rules and tried to put them in some visually attractive, reasonably visually attractive format. But what people focus on, or have focused on, is the second one here that's kind of a little buried in this slide, but this is what you certify when you make your application. It hasn't changed. But you're certifying the current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. And this was some angst about what this means. And there was relief, at least for those that borrowed less than $2 million. There was kind of a deemed necessity, if you will. And there's some discussion, if you will, as to what necessary even means. Does necessary mean it's kind of an absolute requirement, more like essential requirement. And if you didn't, you couldn't operate your business if you didn't get this loan, or is it something that's like convenient, if you will. But the basic thrust of the legislation is to help small businesses remain in business, and more importantly, to keep their employees employed and to pay them, and to not reduce the number of employees, and not to reduce their salary. At least there's incentives to do that. So the legislation has been very liberally interpreted in this area, and I'll leave it the next time as to exactly who's exposed by this. Now the second draw, to move it along here, is slide 90. And this is where we get some more than just subtle changes, if you will.
Hey, Bill, before we get into the second draw, I have a quick question for you. So you've discussed that that we've expanded upon the eligible expenses. What about the people who can participate in the program itself? That's been expanded as well, right?
The expanded, you're talking about the expanded cost.
And expanded participants that can participate in PPP at all. So we also like nonprofits, C6s.
Yeah, there's other categories in there. Yeah, but we haven't.
Okay. So even before the second round, the program's been made more liberal in that we have more people that participate, and we have
chamber groups, other nonprofits, 501(c)(6)s.
Yeah. So
yeah, there's some interesting things that have been added there. On slide and we didn't mention the kind of the terms of it. It's 1% basically, and 5 years if you don't get forgiven, and there's no personal guarantee, no collateral. If you get forgiven, it's basically, well, not basically, it is a grant, and how you spent the money is deductible, and it's not, and you actually get basis for what you spent it on if you capitalize it. So
So,
slide 90, yeah,
so
slide
we'll,
92. If you can go to that one, go ahead.
just that we'll be discussing that in depth next week. Well, we won't, but our set of speakers, our next set of speakers will discuss that in depth on the 28th. And that's very helpful. So there's been some good clarifications there. And then now I understand you're going into the second draw.
This is the second draw. And this is the requirements here, but starting with a little I there. But you previously received a first draw. So if you haven't got a first draw, you go for the first draw. I suppose you go for $1 or something. I don't know how you can play with it, but anyway, the requirement is you've had a first draw, and you've used the full amount of the first draw, or you expect to use it before the second draw is dispersed.
You must pledge to use it if you haven't used
Sorry?
it.
Okay.
You must pledge to use it if you haven't used it.
Yes, exactly. Thank you. Go to the next slide. Some more requirements here. And here we have, except for, I guess you'd broadly call it the restaurant and hospitality industry, but generally it's not more than 300 employees, which I mentioned earlier. This NAICS code, which I guess can't be pronounced as a word, I don't know, but
But we know that it's accommodation and food industry, right? Is that, right?
Yeah, anyway, yeah, the main thing I've seen is a restaurant, but I think it applies to hotels and those kind of clients. So it's just an important provision. They also loosened up on the affiliation rules. That is how you can group them together and the number of physical locations. So if you're in that area, then read these rules carefully, because that's a big opportunity. And then the next one there, they've experienced a reduction in revenue of essentially 25% from what was in the 2019 to 2020. Now the rule set up quarter by quarter. You match the quarters in 2019 to the quarters in 2020, and then you've got situations where people weren't they weren't in business in part of 2019. So they got rules for that, and then they've got ones that's kind of a simplification. If your decline in revenues or your reduction in revenues from 2019 to 2020 overall for the whole year is at least 25%, you qualify. You don't have to do the quarter by quarter.
But it is interesting. So you could be up. You could be up for the year, but down for a particular quarter. I mean, you can kind of choose.
Yeah, I guess if you're down 25% for the whole year, there must be some quarter where you're at least 25% down. Otherwise, mathematically, it's not possible. But you're right. You could have a quarter where you're doing quite well, and then you're sinking.
Also, it works in reverse. If you are down in if you've made more money in 2020 than you did in 2019, so your down period is 2019, you would qualify. It doesn't have to be there's a dip from 2019 and made more money in 20 or the reverse, made more money in 2020 and less money in 2019. You can make more money in 2019 and less in 2020. It works either way.
If you can match up the quarters, that's correct.
Yes, if you can match up the quarters.
Yeah, if you can match up the quarters. And then just to go to a slide, let's see where I was going to go here. I'm sorry. There's some documentation provisions. The 126, for instance, if you're less than 150,000, you've got some latitude in the documentation that's required at the time of the application. But I'm suggesting everybody have the documentation before they make the loan, because you're doing these certifications that you have a reduction. If in fact, when you actually get the stuff, all your accounting work together, and you don't, it doesn't look good. So you may not have to provide it to your lender. I don't know what lenders are doing on this yet, but there's some relaxation for those that have a principal loan for the second draw of 150 or less. So that's the rule there.
But certainly for loans that are under 150 or 150,000 or less, it's just a page application for forgiveness, which makes things much simpler.
50,000 or less, you get, it's very simple.
Yeah, exactly. Then I want to look at the increase rules. I think is well, let's go to 127 just briefly, and then we'll find that one.
And I know that people do have a lot of questions. So again, we will be providing a good amount of time at the end for questions. So.
Okay. Here's again these certifications, and the one I just want to focus on is I don't know if my arrow goes there or not, but anyway, it's 2A, that you've realized this reduction of the 25%, however you have to compute it. So you need to be careful on that particular provision. Let's skip to maybe end of, I think about 132 is where I want to go next. Maybe a little further from the next slide or something. Well, I go back. I'm sorry. There was, one back again. Back.
What did you want to point out, Bill?
Yeah, I wanted to find the increase in amounts here, but somehow I've let's see if I can find it without go ahead and answer a comment or so, but I wanted to find this increase in the second draw, or not the increase in the, I'm sorry, in the first one, wherever I put it. I mean, maybe I put it I'm sorry, maybe I put it before the second draw here. Okay, yeah, let's just go, I'm sorry, let's go back to because it's an important point. Slide 82. More even before that. Let's see. Yeah, slide 79. Let's go to slide 79. This is fine here. Yeah, slide 79. Okay, so I didn't pick this up. We go to slide 80, and then 81 is the one I want to look at. This was the rule I was talking about for partnerships. Before it, I think it was March. There was some discussion about whether partners were treated as employees for purpose of the computing the amount of the loan that could be loan amount. This is for I'm talking 2020, so the rule was clarified. The general partners that would qualify as kind of partner replacement income, how you going to look at it. But loans had already gone through, and they had already been electronically submitted and through the servicing site. And so it wasn't possible to change the amount of loans for partnerships that qualify for this increase. So then the rule changed, but those that already had borrowed earlier were kind of stuck. And this rule, and it comes from the statute itself, this economic aid statute, now permits the partnership not to do a second draw, but really to increase the amount of the loan that they originally requested back in 2020 to include the computation for partnership income up to this $100,000 annual amount. You can't get more than that. And then there's other categories as well that are in here. Slide 85 was the seasonal employees. They also, those rules changed as well. And so they're given relief here. And the subsequent slides, they won't go through, but there's a couple other categories. So if the rules changed on you, or for whatever reason you gave the money back and now you think you need it, need it in the out of the standards we now have necessary, then think about this request to get the increase in the original loan amount. There's a kind of a simplified process. I think the banks or lenders can just do it, online, while you sit there if you have to go in to sign paperwork. So that's that I wanted to pick up. I'm sorry to miss it.
No,
So
that's,
now we're at, yeah, go ahead.
so, I know that there's kind of so this is what I think, because I know obviously this is an enormous handout and there's really important information here where people can come into this handout if they don't want to go to, you've also indicated the source documents, but they can go to the source documents or also start even with your handout in terms of finding opportunities where, where they've expanded the number of people that can participate or the amounts.
Yeah.
Did you have any other exceptions that really stand out before we move to the next part?
I don't know, Larry. I mean, we mentioned we mentioned some of these, the broadcast and restaurant industries and hotels and so on. They're given better treatment. But it's it's specific to whatever your lender category is. There's either fit in the category or not, basically. And I'm finding that when I just mentioned this increase, I've got a lot of partnerships that were denied the full amount of loan they were entitled to. I'm talking about architectural firms, consulting firms of various types, accounting firms, law firms, anybody that's operating as an LLC, as a partnership, who did not count the partnership allocation, if you will, of profit, then they can come in. I mean, there's some computation on how you do that, which I'm not going to go through, but essentially they'll be able to get be treated essentially like an employee. If they're over $100,000 a year, they'll be capped at that amount, just like the other employees, with some special calculations as dealing with items that flow through in a partnership situation.
Hey, Bill, I'm gonna, at this point, once you wrap up on this, I think we're gonna address some questions before we get to the next part of the program.
Sure, go ahead. Yeah, all we have left is a little introduction forgiveness. So
okay, so let's get into some of these, and we do have a number of questions here. So I don't know, Larry, do you want to kind of jump into the Q&A and take some of these? I see from Robert Sheary, for instance. Could start there.
Sure. You'll have when let's see. He asked about forgiveness, and we're going to cover forgiveness in Bill's last section. So
well, let's do this.
The first one: if I'm a professional corporate but have no employees,
he has two 1099 attorneys that work for him and a part-time secretary. Can he get a PPP loan? Then subcategories: how much? As I have no payroll. So this is for Bill and for Larry.
Well, he can only if he has no payroll, then he has to use line 31 on his tax in his tax on his Schedule C to determine a payroll amount, personal payroll amount, right? His income, his personal income, and that number divided by 12 multiplied by 2.5 will amount to the amount of loan he would qualify for. But if he only has 1099s, he can't use 1099 salaries, payroll, because they're not W-2 employees.
Okay.
Yeah, he's apparently using the attorneys as independent contractors. Should be a little careful because he's got also a secretary and paralegal, which to me would be an employee, but he's using 1099s. But that's another issue, right?
That's another important law here in California.
Yeah,
that you gotta
I'd be a little. That's something you should look at.
So
I think attorneys can be maybe independent contractors, depending on what the degree of control you have over them, what they do besides working for you. But yes, I think that's right. What about forgiveness? I think it's the same answer. You can forgive whatever you can get. You can also forgive if it's spent for the proper purposes. Yes, 60% for payroll or owner replacement salary, if you will, and 40% for other qualified costs.
We're going to skip his forgiveness question because we're about to do forgiveness, and then we'll follow.
Yeah, that's. And can you clarify the first straw? It seems to be.
I think we have.
Calling that.
I think we did.
The current program.
It's the first one.
Yeah, I was trying to keep it straight, but let me try again.
No,
We're talking about like
answer that since he asked.
yeah, Larry made a comment too as well, but it seemed to me the first round, if you will, which we didn't really draw draws or anything, it was just kind of the first round, which is in 2020. That was, you could do it one time and it was whatever the amount was, the maximum amount. And then this new program, if you will, where they're calling it the first draw, I think we're talking about people who didn't get a loan in before December 27th and are now eligible for they're eligible for a loan, and because they didn't get anyone the first time around, that's the first draw. If they did have a loan the first time around and now they're in 2021, just leave that 4 or 5 days out, then they're in the second draw program. So the current program has 2 draws, I say 3, increasing your prior first round if you qualify, which I just carried over from the last discussion. The first draw into the new program, because you've never had anything in the first round. And then if you've had something in the first round, now you can get the second draw if you have this reduction in revenue from simplify it from 2019 to 2020. So that's, how I would see that. Is there another one underneath that?
So the next question, and we have we have several, so no worries. We're not running out of questions at all. Total owner benefit. And does total owner benefit count toward a sole proprietor's payroll?
Yeah, can they roll it up? I can't.
It's in the Q&A, Bill. So it reads.
Payroll is quite straightforward, right? It's the amount that you are paying an employee. No dividends or special payments to owners. Nothing that you wouldn't get full tax treatment by the IRS is going to be considered payroll. And so as a result, I don't think that would be.
So Larry, I think that you indicated if you have a sole proprietor on a Schedule C, they'd be looking at their net income.
That's right. Whatever you have on your Schedule C net income, that is the amount that you would use.
Yeah. Next question is, what is the relationship between PPP and SOS? Not quite sure.
Did he mean SVO, the shuttered venue operator?
I was wondering, because that is
because that would be the relevant acronym, I think.
Yeah.
So
why don't we answer it relative to SVO,
okay,
just because it's easier.
Great. So please describe. This is a perfect time to describe the shuttered venue program. So
okay, especially here in the West Coast in Los Angeles, this is especially relevant to us because it focuses on any individual or entity that are either a talent representative, a movie theater, relevant museum, live venue operator, promoter, theatrical promoter, live performing arts organization operator. All of these categories are eligible for the grant. And you could be either organized as a not-for-profit or for-profit or even government-owned entity.
So this is completely separate program from the PPP.
It's totally separate from PPP. If you don't, you can only get this or PPP. You can't get both.
Got it. So the relationship between that is that you to choose. But
you can't. You got to choose.
Okay. As we're talking about, just quickly commenting on other programs. Comment real quickly on the EIDL.
So the Emergency Injury Disaster Loan Grant. Okay, the EIDL loan program is not operating in terms of granting new loans that aren't in progress already, being considered already. But the grant was refunded, but it was funded in what they would call a purposeful way. They focused, the decision was made to do targeted advances to low-income areas. And so if you never received your $10,000 promised EIDL grant, or you received a portion of it, the SBA will make you whole. Now, if you never applied for EIDL in the first place and never got a grant, and you live and your business is located in a low income area, they may consider you after they take care of the folks who are already in process. They may. That presents an interesting discussion, especially amongst attorneys, and that is that this targeted advance conversation is covered under Section 331 of the code that was just passed. But many attorneys point to Section 332, which supposedly amends the act to the degree that it suggests that there is an opportunity to fund other folks with an emergency EIDL grant payment, other folks other than people targeted. And there's some controversy as to whether the SBA is ignoring this on purpose or illegally ignoring it, but that's a matter for continued discussion. But EIDL grants are available for businesses located in low-income areas right now.
And there was a change in the relationship with the PPP. Was there a quick?
Yes, it's now, the grants are now are not taxable.
Okay, or I thought it was in the forgiveness, like when you calculate your forgivable amount, you don't have to include.
Right, that too. You don't have to include, but before they were going to include
The EIDL grant or something.
Yeah.
Subtracted from your forgiveness.
Yeah, there was a deduction for the EIDL grant. Now there's
Now there's
now
that. So
it's
that's
now it's a true grant and forgiven.
I'm sorry I spoke over you, Larry. I apologize.
no.
The next one is, you guys are doing amazing, and thank you. You're both
Yeah,
awesome.
these are good questions.
Bill,
Let's go to the next.
I got a sole proprietor question for you. And again, Larry, thank you for clarifying on those very important programs. Bill, Lynn, someone's asking, I am a sole proprietor, no employees, and 1099. So this is similar to the last one, I guess. I was told I could use 60% of the PPP for me. All I got was 10,000. My income was reduced to 0 initially. I'm not quite sure what the question is there, but I think, Larry, you answered that already, maybe. You typed it.
Oh, but
Yeah,
I don't understand how he got $10,000 if he has no income.
Okay,
well, he may be talking about the EIDL grant, but that would be per employee, so that wouldn't work either, right? The
EIDL grant would have
per employee.
before it was $10,000 flat before they changed it to $1,000 per employee.
Per employee, yeah.
Right. So
Now,
if he got an EIDL grant initially, that would make sense. If he got a $10,000 EIDL grant, that's fine. That's okay. It makes sense. But PPP is based on income. And if he's a sole proprietor, it would have been based on Schedule C, line 31 income. And if he's saying his line 31 income is 0, he wouldn't have gotten anything.
And speaking of the EIDL, someone just asked, where can they find the EIDL? The EIDL stands for Economic Injury Disaster Loan Program.
Right.
Want to read more about that at the SBA website.
Yeah, sba.gov/EIDL.
Perfect.
Let's go to the next.
Question here, if a client has, okay, here, Bill, this one for you. Did anything change, or for both of you, did anything change regarding owner draws from S Corps now qualifying for PPP loans?
Yeah, I mean, Larry can make comment on this, but I would think that with an S corporation, it's the salary amount with some adjustments if you're more than a 5% or more employee, but I don't think your S corporation income that flows through net of all the expenses, I don't think that was part of the qualifying payroll amount. But
Right. I mean, if you're an S corp and you've got under, and for the second draw, if you've got under 500 employees, if under 300 or under employees, and you satisfy the 25% reduction in any quarter requirement, then you can calculate your potential loan. But just because you are an S corp doesn't disqualify you or qualify you for PPP.
Yeah. I think what she's talking about is an S corporation would have a salary to the owners, and then whatever's left over is reportable whatever net income is left is reportable by the owners of the S corporation. So I don't know what owner draws, I think, is where you're getting a distribution from your S corporation that's not salary. And I guess she's asking, did that change? And I don't think it did. I don't think that part qualifies. It's the actual salary that you have, not the salary plus your owner profit, so to speak.
But so if you are applying for PPP as an S corp, you are calculating the total salary, as you said, Bill, and it doesn't matter what the owner draw is, whether it goes up or goes down or it exists or not. It is what is the salary line for employees making $100,000 or less. That's the total that you're interested in.
If you were a partnership and you're the general, let's call it the general partner or even LLC, then the full amount of the profit that goes to the owner,
right,
limited to $100,000 on an annual basis, would qualify. So
yeah.
I don't know what the salary amount is from this S corporation. When it's over $100,000, in which case it wouldn't make any difference. The question's not relevant, But if it's less than 100,000, and this person is getting, we're getting some. The owner's getting something in the way of salary and another piece in the way of owner return. Then she's going to lose the owner return for purposes of computing her PPP loan amount.
This next one is an interesting one. It has a little bit of complexity here. If two entities in the same business, can you aggregate them for purposes of the 25% reduction rule? Well, technically, each entity should apply for its own. If you've got two entities with common ownership, but they're two separate EIN numbers, they're two separate businesses. Yeah. I don't think
I think the aggregation rule only works for the maximum number of employees, right? Am I correct in that?
Right, that's right. That's my understanding.
A bunch of entities and the total is more than 300 or 500, whatever is relevant, then you could disqualify all of the entities.
That's right.
I think the question he's asking, as long as you're not talking about employee limits, you're probably okay.
Right, I agree with you.
I'm sorry. So what's the next one? Let me, was trying to respond to one of those questions that was answered. So have we gone through are we through the chat and into the Q&A?
Okay, there's one, if you have PPP 1 and you use it up, but have not applied for forgiveness, should you apply for forgiveness on PPP 1 before applying for PPP 2? No, you should apply for PPP 2 because that has a deadline. You've got 10 months subsequent to receiving your PPP 1 funds to apply for forgiveness or use it.
Yeah, there's a rule about having to use the first amount before the second amount is dispersed.
But they've changed that. You just have to promise that you will use it. Yeah,
I got it. Okay, all right.
Okay. So let's see. Are we into how is a retirement contribution handled relative to maximum amount of loans sought? Suppose I have a maximum draw of 100K for salary, additional retirement contribution of 30,000. Do I use the 130,000 figure to start, divide by 12 and multiply? And I said by 1.5, or what have I missed, please? Oh, he does. I was confused, but he clarifies the 2.5. I was a little confused.
Yeah, I think he means 2.5 in there, by the way. But that's
right.
Yeah. Right. And apparently he's not in the hospitality industry, if we're talking about people. But anyway, so who wants to take that one?
Yeah, I mean, what he does is he takes the 100,000, and then he's got to get the average month. He's got to divide by. He's got it there. Divide by 12. But the amounts in excess of 100,000 annually is not going to count.
Can't use it.
Right. Can't be in excess of 100,000 salary compensation for any individual. Absolutely.
Exactly.
Okay, so I think that we are probably able to get into loan forgiveness, so the people we at least.
Okay, yeah, we don't have to.
Then we'll go back to questions because we're not done with questions. But we talked about kind of the program generally, enhanced potential users, enhance the uses for the monies. We have loan 1, we have loan 2. Let's talk about forgiveness and then go back into the rest of the questions, if that's okay.
All right, yeah, well, I'll do this quickly because there's a lot of good questions here.
Yes, sir. Very good.
Let's go to slide 134. Okay. Yeah, in this particular area, I didn't put together a detailed description of all of the rules. The reason being for the first set of forgiveness rules, some of those have been changed, and how it's been changed is reflected not only in the statute, but in a interim final rule that was issued in January, a fairly detailed rule. But let's just go through some of the basic. We'll point out some of the differences. As you might recall, let me close this. The major elements, if you will, are how much was dispersed, and something I'm calling a modified total of eligible costs, and then a grossed up payroll amount. So those 3 items. And let's go to the next slide. Just talks of, there can be a difference between the amount that was applied for and the amount you actually get. You know, there could be some rationing within the lenders, for instance, or it could just be that there was some error or something in your paperwork, and so the amount was reduced. But there can be a difference. Then on slide 136, I tried to put together this, what I call modified total eligible cost calculation in a series of Lego blocks, if you will. And so you kind of start with eligible payroll costs, which we've talked about with respect to application. Something I'm calling covered costs, which are the additional costs that were added by the Economic Aid Act of what's we call it 2021. And they're down the lower right. We talked about it before: operational expenditures, property damage, supplier costs, which can be important, and worker protection expenditures. Then you have your business interest, which has some requirements, the business rental costs and utility. And then from that, there's a subtraction for some lenders, borrowers, I'm sorry, for reduction in wages or salaries. And it's a calculation we won't go through, but there is that reduction. It's dollar for dollar. And then you come down to what I call a kind of intermediary step here, where you've adjusted the payroll cost. Then this block that's all put together here, you then multiply by something called a reduction quotient. And this is if you've reduced the number of full-time employee equivalents, which is based on a 40-hour week. And if you reduce that number versus a reference period versus a current period, then if you say you've reduced your full-time amounts by 20%, then you'll multiply this block in the middle here by 80%. You come down to something called modified total costs. Then you go to the next slide, and you take your payroll eligible costs and you gross it up by 60%, or multiply by 1.67. And they've got that calculation. And then you go to the next slide. This is your loan forgiveness amount. And it's the lesser of these 3 amounts: the original amount you borrowed, which makes sense; this modified total, that was that stack of Lego blocks; or your grossed up eligible payroll cost, which is 1.67 times your payroll. So it's the lesser of those 3, and they all can be different. I suppose you could send more on you could send a lot on payroll costs, so it's going to be more than the loan principal amount. So these numbers can be different. The relationship I have there is not necessarily the way they would turn out. Then you add back your idle advance, and that's your forgiveness amount. And there's some definitions. Let's begin on
But
slide
Bill,
one. Go ahead,
before
yeah.
you go on,
Sure.
and before half the audience falls out of their chairs trying to figure how they're going to calculate all of this, if your loanable amount is $50,000 or less, you don't have to go through this.
That's right. Yeah, you got some.
Yeah, you just avoid all of this. It's a very simplified form. It's whether you spent 60% or more on salary and the balance on the allowed expenses. This is only
Maybe
for
it's a time. Yeah, maybe it's a time just to mention briefly. We won't have time to go through them, but we have these three forgiveness application for forgiveness forms that came out in 2021, which are on the website. You've got one that's I think they're 3508S, 3508 EZ, which I think you were talking about, and a 3508, which is a more complicated calculation. So you want to pick out, I mean, the regime that is the least work, and if you will, and most favorable. So you're quite right.
So if you fall into the
think,
simplified, it's just a one-page form, right? Is that the one where the SBA was
the
required?
SS 3508S is the newest form, and it's a very, very simplified form.
Yeah, let's see what they. There's three of them there. So you, yeah, the 3508S is for loans of 150,000 or less. Then you have the, sorry not to look at you, 3508, which is the normal form, and then there's a 3508 EZ form, which is this very simplified form. And so you usually start with the 3508, see if you can qualify. If you can't, move to the next one, the 3508S. And then if you can't fit in there, you got to do this complicated, and it can get very detailed if you're talking about reductions in full-time employee equivalents and reductions in salary. There's rules where it says you don't get kind of double counted. You know, I've got a example which I didn't put in the materials, but because I didn't get the chance to reflect all the new rules. But it can be reasonably complex if you're in that category. I think.
Did we indicate, Bill, the three?
Yeah, I think we really mentioned the a lot of the issues. There is in the last part of the slide deck, beginning on page, I guess it's 155.
And Bill, did we mention the 0.5 calculation?
Yeah, these are just all of the questions that come up that are answered in the IFR that's mentioned up there. So I think Larry, you want to? Yeah,
one thing I want to, I misspoke. The PPP loans of up to 150,000 maximum will be forgiven if you submit this one-page certification description number of the number of employees and that you met the appropriate cost. So it's up to $150,000. You can do the very simple form.
Yeah, you're exempt. Yeah, you're exempt from all of these reductions that I mentioned very briefly. The reductions for full-time employee equivalents and the reduction for salary and wages, if you will.
So I'm about to head us back into questions. So if we can wrap up on loan forgiveness.
Yeah, I think you go back if you want to take some questions for a few more minutes. That's fine.
Bill, did you address the 3.5 for the accommodation and food industry? I saw the 2.5 comp, but if you're in that industry, it's a 3.5 calculation. Is that right?
Yes, that's right.
Okay. So then, fabulous. So Bill, did you have any final comments on loan forgiveness before we head back into questions, which will probably cover some of that too?
I don't have any. I would just suggest for people to take a look on their own, the questions that are in the slide deck beginning, as I said, on page 154 to 159. All of those questions, the answers are in the IFR.
Perfect.
It may not be satisfactory to you, but at least they've come up with answers. They're generally favorable for borrowers, but sometimes the statute limits them and they can't do anything about it.
Well, wonderful. Bill, your handout is comprehensive. It's quite impressive. It's just a wonderful resource. So thank you very much.
Yeah.
It's a good place to go.
Very comprehensive.
And you have also provided, I think, toward the beginning.
Yeah. If there's any demand for a kind of a workshop on forgiveness, because that's really in the trees, if you will, and quite detailed. But if there's some, if people want to go through that, then we can maybe schedule after the second part. We can schedule a kind of really deep dive into forgiveness. But the main thing now, I think people want to get their increases, their first draws and their second draw is done. And they've got, as Larry mentioned, that 10 months after the end of their covered period, which can be up to 24 weeks. The covered period begins on the date the loan is dispersed and ends anytime after 8 weeks, not to exceed 24 weeks. And that was a liberalization too. You don't pick one or the other. You can just pick any day in that 16-week period.
Okay.
One important thing we should mention that will be covered in depth in the next session, but that allowable business expenses paid with PPP funds from both rounds, 1 and 2, are now tax deductible.
Yes.
And then the next round will also discuss important distinctions between federal and state treatment.
Yes.
That's very important. Yeah, thank you.
I look forward to that discussion.
That's why I said it's more complicated than just the one sentence. But I didn't want to leave people hanging for a week not knowing if it's deductible if they couldn't otherwise figure it out. But
and then let's go in. So here's a very interesting question: will there be other lenders than the community banks doing the second draw loans? That is the program just starting with community banks as lenders and then expanding thereafter through other lenders?
It's open now, and there are lists of community lenders. There are people advertising online now saying that they are lenders. You can Google search available lenders and you'll get lists. The SBA provides a list. If you go to sba.gov, you can get a list of, they'll show you a calendar map of the US and you can pick lenders. It just runs a gamut from people like credit unions and most of the local credit unions here that operate in Los Angeles. A lot of the big banks are all active and in. Some of them are still favoring their customers, and I hear Chase will take new people as long as they open a bank account and have it 10 days in effect before they apply for the loan. But then there are lots of online lenders who are available and active, and the SBA will identify both online lenders and also local lenders in your community when you go to the SBA to search.
I might make one point. One of the banks I'm working with, and this would be just late last week, I called them up to see if they could start processing for clients. They said, well, we're having our training session. So they were having the training session almost after the date they were supposed to be open for. I think it was the 14th. There was one window opened, and I can't remember the earlier date. But anyway, they were just getting their training going. And earlier than that, I asked them, "Are you a community bank?" Because I wanted to send somebody in, for that earlier date. And the loan officer didn't know if they were a community bank. So there's some problems out there in the lending community. Likely not with the larger banks, but I was trying to work with the smaller banks because they had this priority, if you will.
I should mention there's one important lender that I think a significant portion of our listening community will be very keen on, and that is it was revealed to me that the USC Credit Union is now open and ready to process loans. So all of
that's
you
good. So the
Trojans
window's open.
out there.
That's good. Yeah.
Well, here's one. Does having taken an idle loan preclude qualification for PPP?
No, not at all.
Please.
How much time are you gonna go another 10 minutes or are you just gonna, what do you want to do, Luan?
Well, we have until, this program is scheduled for until 2, and we've got a number of questions. Did you,
Yeah,
was there more that you wanted to cover as well, Bill?
Yeah, let's go with, well, we start with this person with the S corporation. I'm sorry, says I showed up late, but the client formed a new S corporation in the middle of 2020, paid payroll in 2020. Just a new business. There is a rule for new businesses. I don't know, Larry, do you remember that?
You've got to be in business just prior to COVID. So February something.
15th, I think.
Yeah.
Yeah. So I don't know. We don't know what they said. Or middle of 2020, I think would be in.
It's got to be
July,
February of 2019.
Yeah. Okay. The next one here.
Wait,
If you are a sole proprietor, I'm sorry. Go ahead.
Michelle?
To that, okay, what if it's the same owners in the same business, but they're just changing the form, like a partner, so it's not a completely new business, it's just a reformation of an existing business.
So that makes
That's next
it
week, right? Are we that next week, or
you're dealing with the government, and the government says this is a new EIN number,
okay.
right? So if you're an LLC and you're going to change to a C corp, I mean that just throws a monkey wrench into everything. I would get the loan first and then change.
Yeah, definitely.
All right. Thank you.
Yeah, if there's rules if there's not a rule for your situation, they do invite comments on their interim final rules, which you can send in, and then the questions sometimes end up in this FAQs, which I treat as like a regulation, because even though legally that may not be the right way to look at them, but if they come out with the right answer in the FAQ for you, then I would go with it. You certainly wouldn't. I guess the worst would be you'd have to pay the loan back, but I don't think you'd have any problem with the certification if you followed their guidance.
But if you can avoid it, don't change. Just go through the process.
Well, the problem is if you changed already, but
if you've changed already,
there is a change of ownership procedure. I frankly have not read it, but that's.
I mean, you would think equitably it's the same. You would think that it would qualify, but it's probably some explaining to do.
It's the government.
It says here, will there be other banks other than community banks doing something right?
Yeah.
Yes. Is the program just starting as a, well, I think that's right for, Levan talked about that. They're starting with the community banks, so they want to access certain communities that's smaller business and minority owned women's businesses, et cetera, that were not, weren't able to access the earlier program. The big guys kind of got in early, and the banks concentrated on those particular borrowers, and smaller businesses were kind of given the short stick. And so that's why they started with these community banks and credit unions.
And there's also, I think, another, what, Larry, is it like 25 billion set aside for banks working, I think, is it community institutions are working with in low income
neighborhoods, right? So so they're going to be protected.
Or if you have 10 or fewer employees, did that also come under that? Possibly.
I don't know for sure about the 10 or fewer employees, but
okay, but okay. And believe me, Larry knows. Larry's the person I defer to entirely in this regard. But
here's a good question for you, Larry.
Yeah, we
have taken an idle loan preclude qualification for PPP. That's that's been changed. That's good now.
Yeah, you can get idle and PPP. No, you've always been able to get idle and PPP. You just can't use them for the same purpose.
Yeah, you can't use you can't use the funds you spend for your idle loan to qualify for PPP. So that still exists. Let's see. Please confirm idle loans are now grants. That's
No.
the tax question.
No, idle loans are not grants. Idle loans are loans. There are no more idle loans being given unless your application is still in process. There are a number of people whose applications are still in process. There is an active grant program. So they're two different animals.
You can refinance your idle loan, which then gets you into the forgiveness. So that's a possibility too.
And with respect to the idle advance, or I guess it's a grant, that's really targeted again to people who already had it out there, but were precluded, either didn't get the full 10,000 or there was no funding because the funds were gone, right?
That's the current targeted advanced strategy for the idle program.
Okay.
It may change, so keep tuned.
Okay. Okay.
Where do we locate the grant or available loans? The grant information, if you applied for idle, received either nothing or a partial advance amount, then SBA will contact you. You don't contact them. They know who you are. There are no more idle loans being considered at the present time for new applicants. If you went to the SBA website and tried to apply for an idle loan, it would tell you that program is closed. So, but there are other SBA lending programs available. And we can, you can either get that information on what's available, but those are accessible through banks and at the SBDC, where at El Camino College or any of the fine SBDCs in LA County, Orange County area, we can help you identify what you might qualify for and who the appropriate lending institution is for non-idle or PPP loan amounts.
Here's one for you, Larry. Again, it looks like it's somebody who doesn't have much income left. Linda, or a client anyway.
Let's see. What's the? I didn't have the question up. So what's it? Could you read that question?
Yeah, it says I got $10,000 of PPP. It came in two pieces for some reason, and an SBA loan of $55,000. Then it says, as a sole proprietor, I was told I could use 60% of the 10 for me. I guess owner replacement revenue. Gross revenue was 103,000. After deducting costs, I got 19,180. It says, I have no idea what line 33 you were asking about, which that's why I think it was your question.
Okay, so if you're a sole proprietor or 1099, in order to calculate your available, what you would get as a PPP loan amount, you would use your income divided by 12 multiplied by either 2.5 or 3.5. That's where the line 31 of Schedule C comes in. If you have employees and you're an S Corp or an LLC, then you're not going to talk about line 31. You're going to use your payroll run to calculate what your loan amount is.
All right. So
okay, so this person is at the. It says I was confused about who could use the 3508 EZ. Well, I don't know who confused you, but let me try again. The best place to go is to the instructions or what they call a checklist. Just pull down from the SBA website the 3508 EZ. And then on the checklist, it's got a, I don't know what you would kind of call it. It's got two boxes. And in order to use the EZ, you've got to check one of the two boxes. To read them to you, I think would be a little difficult because they have multiple parts. But just to give you some flavor of it, it says the borrower did not reduce annual salary by more than 25% during the covered period. Okay. And did not reduce the number of employees between a certain period. And then you ignore certain situations where you couldn't rehire, or you're unable to rehire, or you offer to restore an employee, to hire them back, if you will, or bring them back to the service, and they refuse. And then that's one category. And then the other one is you didn't reduce your annual wages by 25% or more, and you were unable to operate during the covered period compared to February 15, 2020 because of compliance with COVID type restrictions. And then, so that's the other box. So there are several paragraphs. I just kind of gave you the flavor of them. So I would take that checklist, and then it's quite clear, whether you qualify or not. But it's basically you didn't reduce your employees, and you didn't reduce your salary, or you had a reason why that
Well,
occurred, which is because you
Bill,
wouldn't come back for some reason.
I would suggest that the controlling question is your loan 150,000 or less?
Yeah.
If it is, then you want to go to the 3508S because it is the simplest. It doesn't require you to justify anything other than the fact that you use 60% on payroll and 40% on other expenses.
Larry, what if one has two loans? Someone has asked about, can they do one forgiveness request?
Wait a minute. So what do you mean
With
two
separate
loans? What
requests.
two?
So let's say
can only,
they've gotten the first loan.
you
and-
can't, there's not enough time to get the second loan.
Okay. That's good.
You can only
All
get
right.
one within 90 days.
Okay. So gentlemen, I think we are up. It is 2:00.
Oh my
Okay,
goodness.
good.
I don't know. I guess I was just having too much fun.
I'm not done yet.
I know.
Yeah, we can go on for the rest of the afternoon, but there's so much to cover in this.
Well, so something we just pointed out that, we probably, Michelle, Michelle is the chair of our tax section, and so our illustrious leader in that section. But, Bill and I had discussed maybe there could be like a loan forgiveness workshop at some point, later in the year, because it is so detailed. For people if they're interested in that. So never fear, folks. We get that probably there are questions that are going to be questions that's still remaining. I believe that in the materials you have Larry and Bill's contact information. I'm not sure mine's in there, but I'm reachable. It's easy to find me. And I'm still interested. I want to do some more on that, the targeted, the underserved community. I think in terms of what those qualifications were, Larry, you got me interested in that. I want to make sure that I get those nailed down.
Well, one thing I want to leave with is, as Bill has indicated, there are frequent changes and adjustments as people make comments about their real life situations, and they don't exactly mesh with what Congress was thinking or the SBA's interpretation. They come out with these guidelines and guidances. And so what we are saying today, some of which can change tomorrow. So pay close attention to the press and stay in touch. I am sure that the Bar Association will send announcements out of appropriate changes. I'll certainly be in touch with Michelle and Levon to let them know if we see anything that should be passed on.
Absolutely. That's perfect suggestion. We'll make sure to keep everyone informed. And this was just really a lot of fun. So thank you to fellow panelists, to our illustrious tax leader, to Alex, who's fantastic and handling the materials in the program, and to our audience who gave us.
And your sponsors.
Yes.
And I also want to thank the panelists. And next week is our part 2 of this program, which is, okay, now you have this ability to get this loan. What are the possible footfalls? What are the tax implications? Are you thinking of everything? How can it impact your business in ways that you're not thinking of. So it's the cautionary tale. So we hope to see you back next week. And thank you, everybody, and just have a wonderful weekend. And
Thanks.
bye.
Thank you.
Okay.
Take care.
Bye.
Bye-bye.
Bye-bye. All right. Nice to meet you, Larry.
Nice to meet you too. Thank you.